Lance Roberts here with realinvestmentadvice.com. The question is why did we start selling investments on Friday to raise cash and get a little bit more defensive? A couple of reasons here. Markets have had a very strong advance here over the course of the last couple of months in particular, and our money flow indicators are now back above the 90% level, which typically precedes either corrections or consolidations in the markets. And again, when we take a look at just the kind of push in the markets at this point, we have gotten well ahead of not only the fundamentals of the market, but also the technical deviations are now at levels that have typically preceded short to intermediate term corrections, 3, 5, 7, 10%, certainly within the norms of a market cycle. The other side of this is that if we look longer term at a weekly chart of the S&P 500, we see the same indicator of our money flows now beginning to peak there as well, also suggesting that this current run in the market that began back in March of 2020 has now likely begun to reach its peak as well. Again, this doesn't necessarily mean that the markets are going to have a 20 or 30% crash, although it has previously. But what these signals do tend to precede is at least a more important and meaningful correction or consolidation process in the markets. But it's not just the technical deviations that we're talking about here. It's also a sentiment issue. Things are definitely beginning to get a bit exaggerated in the markets. And again, when we take a look, Bitcoin is one of those good examples here. Again, exuberance in Bitcoin has really kind of gotten well ahead of some of the underlying fundamentals. And interestingly enough, corrections in Bitcoin tend to precede corrections in the stock market. That's absolutely expected here, as Bitcoin as well as the stock market, a lot of that is a sentiment-based investment. I've got to be in, I've got to chase these prices until they begin to correct. And of course, when they begin to correct, sentiment changes in the other direction. Not surprisingly that these tend to correlate well with one another. Also taking a look at insiders here, as buybacks have gotten approved here, of course, by banks to start buying back stock, insiders are dumping stock as fast as they can and at a record pace into the markets. Insiders are always the beneficiary of insider selling, and that's what we're seeing here a lot. Also, another sign that maybe insiders know a little bit more about companies than what markets do and participants do, and again, taking advantage of high prices here to liquidate their shares. Another big concern, of course, is that the U.S. is being outperformed by international, and the thought here is that international stocks are cheap relative to the U.S., and that's why they're outperforming. May be the case, with the exception, though, that international stocks and domestic stocks are dependent upon economic growth. And the one thing we're seeing here is that both on a manufacturing and service side, those countries are underperforming the economic recovery of the U.S. So while they may appear to be cheaper than the U.S. on a pure valuation basis relative to the U.S., the actual valuation may not be nearly as cheap as it seems when you start looking at their economic performance as well overseas. Again, investors overpaying for those expectations. Small cap, another really good example here. Small cap's very dependent upon the underlying economic growth rate to support those growth levels of those companies. Currently, right now, those are outperforming most other markets to a large degree, and the deviation of small caps is now at a historic extreme relative to any other period in history, and unlikely that economic growth is going to be fast enough to support the valuations that investors are currently paying on a 2-year forward basis for these small cap stocks. If we can't get into stocks because we're out of cash, another way to get into stocks is to go into leverage, and we've seen a massive spike in leverage here just over the course of the last couple of months, in particular, as investors are really working hard to try to get as long equity exposure as they can and doing it on leverage. And in fact, these types of spikes in leverage only occur at previous market peaks in history. Again, one of those other kind of concerns here, markets are very sentiment driven, and a change in sentiment not only unwinds stock ownership, but if you're doing it on leverage, that increases the selling pressure of the markets. And again, it's not just individuals. This is also professional investors as well, currently carrying 113% exposure to equities on a professional manager basis, second highest level on record of this index. This is just one of those areas that typically tends to align with at least short to intermediate term corrections in the markets. And when we take a look at composite allocation recommendations, of course, of individuals and professionals, also back to one of the highest levels we've seen in history. And again, each one of these areas also, these levels have always preceded short to intermediate term corrections in the markets. And again, you got to remember that we're paying the highest level of valuation outside of the dot-com era boom that we've ever seen. So investors are not only all in and leveraged, and expectations are extremely high. This is a great setup here for a change in that sentiment that leads to a correction. That's why we took a little bit of cash off the table on Fridays and are becoming a little bit more defensive. I'm your host, Lance Roberts, for 3 minutes on markets and money, or thereabouts. We'll see you next time.